You bet.
Joining us now for a look at markets ahead of the opening bell, Sylvia Jablonski, CIO and CEO at Defiance ETFs. Sylvia, we were just chatting a short while ago about how we haven't really experienced this flight to safety trade, the safe haven trade that I think many people may have expected had it not been so clearly telegraphed on Friday, leading to, in part, the sell-off. What do you make of the pre-market activity this morning? And do you agree with Mike that the market has other things that it's focused on right now?
Good morning, Leslie. Well, I think there are a couple of things going on. So first, because of the news going into the weekend, we saw this kind of flight to safety and hedging. We saw a pickup in metals and gold and oil-related products and alternative investments. And I would expect that to happen. I don't think it's going to necessarily propel forward. But I do think that there's enough of, it's sort of cheap enough to hedge, and there's enough of a good reason to do it just because of geopolitics and what we saw. To Mike's point, he makes a really interesting point. What's the difference? I think there was this, major strike this weekend, but prior to that, there always is this instability in the region, and there has been for a while. And so I don't think that people will necessarily, kind of panic and come out of growth stocks and high risk stocks and go completely to safety. But I do think you'll probably see some pickup in like VIX, alternative metals, and different hedging types of products in the near term.
Do you think then that the markets may have overreacted a bit on Friday, especially to earnings, because there were these overarching concerns over inflation and geopolitical issues? Or do you think the market has been appropriately pricing in earnings so far? And what does that portend for the rest of earnings season?
So it feels a little bit like it did when we first got the news about Russia and Ukraine, right? You saw the market kind of have this stark reaction right out of the gates, and things started to slow down and stocks fell and things like this. And so I think that there was a bit of an overreaction in terms of earnings and pulling back estimates. And so that probably bodes well for earnings season. I do expect earnings to look pretty good, particularly coming out of tech. And so the bar is pretty low, although the expectations will be high to now beat this low bar. I do think it'll come to fruition. And then in terms of just what we've seen in the last 3 weeks, of course we've seen people hedging and picking up energy, metals, and things like this. But tech has fallen for the last 3 weeks, right? So for an investor who's been sitting on the sidelines, now your Microsoft and Google, Amazon, some of the chip names and things like that have fallen off of all-time highs. And maybe we'll start to see some of the cash going that way.
Yeah, and of course, some of those stocks sometimes do act as kind of defensive destinations in the market. Sylvia, I guess the big question is, if you go back a few weeks, it seemed like there was almost nothing that was pushing against the further advance in the market, right? You had, obviously, the economy outperforming expectations. Earnings are turning higher. You had this idea that the Fed was going to be cutting into a good economy. Bond yields were tame. So a lot of those have kind of at least been complicated at this point. And we only have not even a 3% pullback in the S&P. I guess, how do you think about the risk reward right now looking ahead?
Yeah, I think that it's actually a good time to come back into the markets. And as you said, we might not necessarily get those 3 rate cuts that we wanted. The Fed is uncertain. Geopolitical issues are hovering over us. But all of those things were more or less there. In terms of rate hikes, corporate America has held up really well. Earnings have been very, very strong. Companies have performed. We've seen GDP growth. And so I think if the Fed cuts twice instead of 3 times, it doesn't matter that much. And I also think that cuts are still very close to being on the horizon. And so we're there. Maybe we're not there in the next couple of months, but I do think that we're going to come to a point where financial conditions ease, although they're really not that stringent. And again, if you look at earnings results and things like this, we can see a really good case to come back into stocks. I think sitting in kind of the treasuries for the long term, there's that $6 trillion on the sidelines. Stock markets over the last year, whether it's NASDAQ, whether it's S&P 500, have proven that you're better off being in equities. And I think that barring any major kind of reaction in the Middle East that spans on beyond what we've seen, I do think that markets are ripe for growth this year.